Hello, this is Seymour Peterson, your host for Card Table Commentary. Back in installment number 11, we set the scene for a crisis regarding defaults on various real estate securities. At the same time, there was a developing funding crisis for the banks. We have talked about savers before, and savers are a group of people, a pretty big group of people, who are adverse to risk, and they don't usually invest in things like stock or bonds that could go down. They prefer to be in insured bank accounts, certificates of deposit, or most popularly, money market mutual funds. Money market mutual funds provided a good return in excess of inflation through the 70s, 80s, and 90s. Money market funds were invested primarily in commercial paper issued by the largest and most credit-worthy corporations like General Electric and General Motors. But when foreign competition started to hurt the prospects of some of these large companies, and as they took advantage of opportunities to leverage themselves, the money market funds quit buying those type of securities, and instead they would buy commercial paper issued by U.S. and international banks. I am myself am a saver, and I used to get these reports on my money market funds, and I would sometimes look at them and see what they were holding. And I noticed during the 2000s how they trended away from these large corporate borrowers that they used to lend to, and pretty soon all the assets were invested with banks of various types and in various countries, but in commercial paper with these banks. And it occurred to me that by investing in these banks, they were simply investing in the same companies they used to invest in, and decided that they were no longer creditworthy. But because the bank's name was associated with it, or maybe because of diversification, they felt that these were a better risk. But when banks started to have problems with these real estate securities and other things that started to happen at the same time, the managers of these money market funds would refuse to renew their paper when it turned over. And most of these commercial paper loans were really only for 30 days or so. So it didn't take long, and there was a tremendous outflow of money from the banks because they'd come to depend on this money market money. It was cheap, and it was readily available, and nobody seemed to question it until there was a crisis, and then they withdrew all the money. It was a similar situation to what happened with Jimmy Stewart's bank in It's a Wonderful Life. If that wasn't enough of a problem, investors started to learn about derivative securities. Derivatives are a financial product it's called a derivative because it derives its value from some other security. And they had become very popular in the 90s and the 2000s. And a derivative might be issued to guarantee the payment on a bond, or to be able to hedge interest rates. There were derivatives of various kinds, and they were plentiful, and a lot of people were using them to hedge their portfolios or to provide safety for risky investments. But not most people didn't really know much about these things, and the average investor certainly didn't. And there were so many interrelationships and complexities in the derivative markets that when people became aware that there were a lot of these things outstanding, they got very scared about it because nobody knew exactly what it was. And a lot of these derivatives were issued by insurance companies, but they weren't subject to the same reserve requirements and such that regular insurance was. They weren't regulated in the same way. And when investors became aware that some of the large insurers, and especially AIG, had issued derivatives guaranteeing billions of dollars worth of bonds, many of which might have had some exposure to these real estate problems, they fled. They got real afraid, and they got away as far away from these things as they could. They wouldn't provide them any money, and the derivative markets all froze up because everybody was afraid of what was going to happen. It turned out that one of the biggest places that was going to sustain losses on real estate securities were the quasi-governmental agencies, Fannie Mae and Freddie Mac, that bought and sold mortgages. They had decided that they needed to compete with these private issuers that had developed all these mortgages to attract first-time buyers with the teaser rates and the zero down payments. And Fannie Mae wasn't getting any of this business anymore. And so they developed their own products with low down payments and lax credit standards. And before you knew it, they were involved in this whole thing. Now, there's a lot of debt outstanding. They basically buy more than half of the mortgages that come to market, and then they repackage that debt and sell it to investors. And so there's a lot of this debt outstanding, and these are quasi-government agencies, and people, they weren't specifically guaranteed by the federal government, but people always felt that if they got into trouble, that the federal government would step in and make good on any losses. And indeed, that's what had to happen. All of this paralyzed the investment markets with fear and uncertainty. And then when in September of 2008, Lehman Brothers, one of the large and well-established investment banks, had to declare bankruptcy, it triggered a whole massive effort to try to keep the whole economy from collapsing. And it was as a result of these efforts and all of the interventions that were made into the marketplace and all the government guarantees and stuff that all this stuff led to what I call the new economy. And we'll talk about that in the next installment.